Welcome back to Trendlines over Headlines, the show where we break down the markets with some of the best traders and analysts out there. My name is Patrick Dunawilla and I'll be your host. Joining me today is Joe Fahmy of Zor Capital. Joe has been a trader for 22 years and he's been featured in all the major financial publications from CNBC to the Wall Street Journal. He's got a great read on the markets and an even better sense of humor, so I can't wait to catch up with him. But before we sit down with Joe, it's Friday, the markets are closed, so let's take a quick look at how this week played out. Hey guys, thanks for watching. Just a quick reminder, be sure to click like and subscribe so we can continue bringing you awesome content. Thanks. All right, so all four major indices closed lower this week. The Dow led, but still fell a little over 2.5%. The Russell 2000 lagged, dropping 5%. Turning to the S&P 500, we fell 4 out of 5 days this week. And last week we talked about how it was testing that downtrend line that's been in place all year. And sure enough, we got rejected there on Monday, and we're back below that 200-day moving average. So not the week the bulls had hoped for, and those two continue to be the next upside objectives. If we can get above them next week, that would be a big win for the bulls, but so far we're seeing rejection. Now, taking a quick look at the sector performance, all 11 sectors closed lower this week. Utilities led, but still slipped about 0.25%. Energy was the clear laggard, dropping more than 8%. Anyways, that's enough for me. Let's talk to Joe. All right, Joe, welcome on to the show, and thank you for joining us today.
Thanks for having me. Appreciate it.
Yeah, so before we get into the market stuff, I wanted to get a little bit more about your process and also your time frame too, because I think in any market conversation, it's really important to define that up front, right? I had Dan Russo on the show a few weeks ago, and he said something I really liked. He said something like 90% of all the disagreements you have about the market with people or on Twitter, it all comes down to time frame for the most part. So tell us a little bit more about your process and your time frame.
Sure. Yeah, it's my general philosophy is the market's healthy 2 to 3 times a year. When you go back and look historically, and again, I'm talking in terms of probabilities and statistics, for the most part, the market gives you 2 or 3 times where you have a nice uptrend, a nice sort of opportunity from the long side to trade the markets. And what I try to do is identify those healthy times. So you want to make sure the wind is at your back from the markets. And then when it is healthy, do my best to expose capital to the strongest stocks that I can find. I consider myself a growth manager, so I'm trying to put as many factors as possible in my favor to help my probabilities of success. So when the market's healthy, be in strong fundamental stocks that have strong earnings and sales growth, combine them with strong technical patterns that are showing accumulation from the institutions. And then I also like to use some other factors like seasonality, unusual option activity. But basically, that's what I'm trying to do in a nutshell, is when it's healthy, expose capital to those strongest stocks. And time frame can be anywhere from 2 to 3 weeks up to 2 to 3 months, sort of a swing trade time frame for my holding period.
I see. So it's kind of a little bit of fundamentals with a technical overlay on it. I know you're a big William O'Neill fan too, right? Kind of that same flavor of analysis. Is that right?
Yeah, I mean, William O'Neill, Investors Business Daily, the whole CANSLIM acronym, it's essentially a growth strategy. So even like Fidelity Contrafund, it's a growth strategy. They're one of the growth, biggest growth mutual funds. So I like to think of it as a blueprint that I use from that type of blueprint and then apply it to what works with my strategy, what works with my time frame, and what works for your personality as well.
Yeah. So let's get right into the markets now. We're recording this on Thursday, December 8th. So the week isn't quite over yet, but here we are. The S&P 500 has been chopping around that 200-day moving average for a few weeks now, and we got rejected at that downtrend line. What was it, earlier this week? And of course, we're getting to that time of year where we're going to be hearing about the Santa Claus rally nonstop now. So you mentioned seasonality was a part of your process. And do you think Santa Claus is going to come bearing gifts this year?
I mean, it's possible. I always like to talk in terms of probabilities. A lot of people, when I'm sure you're the same way, when they ask you questions, they think there's a right and a wrong answer. It's not always, black and white. There's a lot of gray in the markets. There's not always a right answer. So I talk in terms of probabilities, where statistically August and September are two of the weaker months of the year, and then November, December, January, and specifically to what you're referring to, that Santa Claus rally, the last 5 days of December into the first couple of days of January are statistically, a good time to be in the markets. But I still need things to line up. I still need the overall backdrop and picture to line up. So, I mean, it looks like things are somewhat stabilizing in the markets. But my honest opinion is I think we're going to be in a range for a little bit and chop around for a little bit. And we'll see if Santa Claus shows up.
So, on that note, if you really are just looking at the chart, what are some of the levels and indicators that you're watching on the S&P 500?
Well, the S&P, I'd like to see it ideally get back above that 200-day. You alluded to rejection on that trend line. And when I talked about those 2 to 3 times a year, the market's healthy. Ideally, you want to have most of the major indices, S&P and NASDAQ Composite are the two main ones I look at. You want to have them above their 10-day, 21-day, 50-day, and 200-day. So we're still sort of in this trying to bottom out, still sort of in this bear market. But ideally, for a nice, the keyword being sustained uptrend, I would like to see the overall markets above the 50-day and the 200-day moving average.
Yeah, and I really like what you said there. Market's only healthy 2-3 times a year. In fact, it reminds me of that Paul Tudor Jones quote. I'm sure you've heard it, where it's like, markets only trend 15% of the time. The rest, they're just kind of choppy and sideways.
Yeah, that's right. We're in corrections a lot of times, bear markets, recessions, more than people realize. But there are those windows every once in a while where the market presents strong opportunities for a nice trend. Yeah.
So, here we are just a few weeks away from the end of the year. And I've been finding myself thinking about it a lot lately, about how bad this year was, right? In terms of just persistent weakness. I think it's fair to compare it to years like 2001 and 2008, some of the worst years for markets in recent history. And, I wasn't really there for that. I was still a teenager for most of that. But you were, and I want to get your thoughts on what you think of that comparison and, how this year compares to years like 2001 and 2008.
Yeah, no, I remember those years well. For people who don't know, full disclosure, I'm 108 years old, so I do remember a lot of those years. But I know you guys are very technical based, and we have to just briefly talk about the macro, because I think that's 90% of the reason we're down this year. And what compares to 08 and 2000 is liquidity. It's very simple. When we had that strong trend after the pandemic, it was 3 main reasons: because the Fed kept interest rates at 0, they were buying bonds, expanding their balance sheet. And then fast forward to last year, December, what year are we in? December 2021. With COVID, I never know if something was Tuesday or 3 years ago. So
listen, I'm ready for 2022 to be done.
Exactly. So December of 2021, the Fed took away those 3 things in 3 separate announcements at the end of December, end of 2021 into early 2022, saying we're going to stop buying bonds, we're going to start raising rates, and then we're going to decrease our balance sheet. So I feel that the main reason for this decline is liquidity and the Fed putting constraints on the system. How that compares to 2000 is before 2000, there was something called Y2K, where they just thought on December 31st, 1999, every computer was going to blow up. Because you got to remember, PCs were kind of new in the late 90s, and they were very concerned about that. So the Fed provided a form of easing where they kept interest rates stable, doubled the money supply, different versions and variations of easing. And then when they realized March, April of 2000, okay, all the computers are fine. And I'm simplifying this, but that's when they started to take that liquidity out of the system. So there's a reason Marty Zweig came up with the expression, don't fight the Fed, because when they're providing liquidity, it's usually a high probability time and an equity friendly environment to be in stocks. When they're taking liquidity out of the system, as they've been doing the majority of this year, that's a time to get defensive. And to your point, where equities will have a very difficult time of making progress.
Yeah, I mean, I probably had my baby teeth still in 2001, but I didn't know that. So the Fed was literally that concerned about Y2K and what might happen?
Yeah, I mean, if you look at the charts, the Nasdaq was straight up. I think it broke out. The composite broke out at, I don't know, around 2,000, 2,500 and went to over 5,000. But yeah, the Fed was concerned. The difference was there weren't all these different financial networks. There weren't 10 or 20 social media sites and all this stuff. Now everyone wants to talk macro. Even friends that I don't even know if they know how to spell macro or ask me about interest rates and all this stuff. But the Fed has always been involved in the markets. It just hasn't been as pronounced and as popular in mainstream media as it has been, especially over the last couple of years.
Yeah, and as I mentioned, I think we're all starting to reflect on this year as we get closer to the end of it. And I don't think most people, even financial professionals, have really come to terms with how bad this year has been, especially when you add bonds into the mix. The 60-40 portfolio, one of the worst years on record. So I want to move on to sentiment and what you what your read on sentiment is right now. And we've all seen this classic, framework of investors' emotion through the market cycle. So, if I had to ask you where you think we are on this cycle of emotions chart, where would you pin it?
That's a great question. And sentiment, a couple of things. Number one, it's a secondary indicator to me than to the price action of stocks and the overall markets and indices. So I use it as a secondary indicator. The other thing is it's hard to get a read on sentiment from just one sentiment measure. You have, Investors Intelligence and NAAIM, active investment managers, CNN Fear Greed, put to call ratios, AAII, there's so many of them. Ned Davis has great sentiment research. I look at 8 to 10 different things collectively because I think people want to use sentiment to justify their position, because there are some people calling for, another big leg down in the markets here, saying that the Fed interest rate hikes haven't even kicked into the system, and we really haven't seen a restrictive policy really kick in. It takes a while. It's like a big tanker ship for these interest rate hikes to kick into the system. So there are some people calling for much lower levels from here, S&P 3,000 or even lower. And then on the other side, I talk to people who are still on margin and haven't sold their growth stocks. They're unfortunately down 50 to 90% because they've held a lot of the popular high-flying growth stocks from 2020 and 2021. So my point is it's very difficult to get a read depending on that. I mean, maybe we're sort of in that denial phase and we might still have some time to bottom out, but I don't think we ever really reach that panic phase because of, to your point, we just seem to have these counter trend rallies that give people hope and so forth. So it's just a very difficult question overall to answer.
And part of the reason I think the comparisons to years like 2001 and 2008 are fair is because a lot of retail investors were invested in these growth stocks, right? Some of these household names like Meta, Facebook, fell like 75% from its highs. And you add in some of the others like Amazon and Google, some of the others that are very widely held, and these are down over 50%, at their max drawdown this year. So, I'm not asking for your price target on growth or anything silly like that, because I know you're flexible and you'll change your mind as the data develops. But would you expect this underperformance in growth to continue next year?
Yeah, that's a great question. I think it's all dependent on the Fed. I think the Fed is getting close to this interest rate hiking cycle to be over. They started at 0%. We're roughly at 4%. They've talked about their terminal rate being 5%. So let's say they do another half a point in their December meeting, quarter and a quarter. So now we're looking at, call it March, which coincidentally is when that 3-year bear market from March of 2000 to March of 03 started to bottom. And then that 18-month bear market from October of 07 to March of 09. So in both of those bear markets, I know it's a sample size of only 2, but in both of those bear markets, even the faster bear market during COVID, they all bottomed in March. So that's something to possibly pay attention to, where value can still do well, lower valuation names. And then I think when the Fed is done, they start to hint that they are, inflation might be slowly coming down and inflation will be under control. That's when I think institutions will lever back up again, and you'll start to see money being put into some of the higher PE and some of the growth stocks. So I think you'll see growth overall does better. I just think you'll start to see it maybe in the second half of next year.
And one big head scratcher has been rates have come down recently. They pulled back a little bit in the past 2 months or so. I think the 10-year closed at a 2 or 3 month low recently. And yet you haven't seen growth stocks rebound the way that you might think. Rates have kind of been the driver for all this underperformance and growth pretty much all year. And yet on this recent pullback in rates, you really didn't see growth make a stand. Like ARK is still just hovering there near its lowest levels in years, right?
Yeah,
So,
I mean, people, go ahead. Sorry, finish. Yeah, sorry.
No, so I'm just wondering, like, kind of what, that was supposed to be the catalyst. So what is it going to take to get growth going?
Well, it depends on growth. If we're talking large cap or small and mid cap growth, meaning that just let's say the Fed does eventually stop this rate hiking cycle, it doesn't mean the teacher's out of the classroom and you can lever back up and just growth is going to go higher. I equate, to use your analogy of 2000 to now, back in the 90s, from 95 to 2000, some of the fangs of that time were Dell, Microsoft, Cisco, and Intel, where it was the PC boom, where Dell and Compaq, some others, were the leaders in PCs. Microsoft put the software in them. Intel was a leader in chips, and Cisco connected them all together. They went on huge runs, and then they became dead money for a while because the law of large numbers starts to kick in, where it's hard to sustain that type of growth with that large of revenue. So the analogy to today is a lot of the FANG names have gone on huge runs, and they're going to be dead money for a while. They might they might not go down, but they might just oscillate in a range and be dead money because their best days are behind them. So I think that's where the point I've been stressing to people is, don't be afraid of new names and newer growth leaders that do have that really strong earnings and sales growth. And I think they're going to start to appear in the charts with good relative strength coming out of this bear market.
Yeah, I had Walter Deemer on the show a few weeks ago, and I know I've mentioned this before, but we talked a lot about the go-go years, in the 60s. And I think it was really interesting that the growth stocks of that era, the McDonald's, the Johnson & Johnson's, stocks like that, stocks that we think of as blue chips now, they were growth back then. So, it kind of begs the question, are we going to be thinking about the Amazons and the Facebooks and the Googles as value stocks in 20 years from now,
It's very possible. I mean, Home Depot and Walmart were monster growth leaders. McDonald's, to your point, the ones that we consider blue chips, sort of steady value, not huge growth, maybe single digits, depending on the economy and the timing. But that's why what they end up doing is, to add shareholder value, is they're making so much money that they might add a dividend to keep some of their investors around, where they're not going out of business, but they're not growing, but they have great cash flow. So yeah, it's very possible that the leaders of the past several years will become, some of the value blue chip names that will just sort of oscillate around with the markets.
So I know you're a big relative strength guy. Are there any stocks or areas that you do like here?
I'm noticing medical products are acting well. I know that's sort of a broad group, but Healthcare, medical products, biotech. I kind of put them all together because as the population is living longer and so forth, I by relative strength, my definition is when the market's going down, stocks relative to the markets that are holding up well. It's not necessarily RSI. It's just saying, okay, we're 10, 15, 20, 30% off of our highs. What are the stocks that are near highs? So I'm definitely noticing a lot of medical products, healthcare, biotech that are holding up better. I think some of them were, especially biotech, were held down during COVID because the FDA had a priority for vaccines to come out, and besides a lot of companies were shut down, but their priorities were on the vaccines and not on some other phase trials. So some of those companies are starting to, emerge with some good positive data, and medical products as well. Like I said, with an aging population, I've noticed a lot of them, for diabetes, all sorts of, heart, everything like that, BPH, all sorts of different diagnoses. A lot of these medical product stocks are doing well.
Yeah, a lot of healthcare. I mean, like Bristol Myers Squibb looks great. Even just IBB, you look at the biotech index, and it's formed that nice base over a year or so. So let me ask you about another area of relative strength, and this has just really shown up over the past 2 months, and that's emerging markets. I mean, emerging markets relative to U.S. stocks have done terrible for over a decade now, but in the last couple months, they've shown some strength. And, we actually, like if you look at a chart of EEM relative to the S&P 500, emerging markets relative to the S&P 500, we actually closed above that downtrend that we've been in for like 2 years, and we broke the 200-day today. So do you think that's kind of an area that has promise, or is it just going to be more of the same story of underperformance?
I mean, it's potential. I mean, it's always been a speculative area, even with like asset allocation models. They try to keep a lower portion to emerging markets and international and so forth. But the markets are a discounting mechanism. So they tend to trade on what's going to happen 6 to 9 months from now. By the time all the bad news is out there, it's already been priced in, and certain markets have already turned around. It's not necessarily an area that I follow very closely. I just pulled up a chart of EEM, which, to your point, is definitely relative to the S&P is acting well. But it's possible that, from that chart, they've just been beaten down and been in such a decline and a downtrend for so long. It's possible, no pun intended, it's starting to emerge out of this range. And I think that would be a good sign for risk on if this trend continues and if it can sustain something like a new uptrend here.
Yeah, and of course, you can't talk about emerging markets without China because it is such a large portion of it. And man, Chinese stocks showing relative strength. I mean, in the past couple months off those lows, they're up like 71%. Now, granted, they're still down a lot from their highs, but this was one of the first areas that started lagging and really showing that weakness before other growthier or aggressive areas did. So maybe that's a tell. What do you think?
Yeah, I mean, the number one issue with Chinese stocks is regulatory risk. There's risk in everything, but with Chinese stocks, it's regulatory risk. So it really just depends on, there was a lot of them declined because there was talks of delisting and if there's any sort of global tensions and so forth. So you also have that geopolitical risk. But when people do short these things because they think they're going to be delisted, or maybe their growth will slow, or they're just going to get decimated, that's when you can get, I mean, usually these counter trend rallies can be 20, 30%. So the one you pointed out there, 70%, might be more than just a short covering rally. So it could be something there. And it's maybe, like to your point, that's where we're seeing the strength in emerging markets because of this. But again, it would just be a good sign if this can sustain after a big move in either a stock or an index. If it can make a big move and hold that gain and not give it back and sustain that type of move and consolidate well, that could be a good sign for risk on overall globally if we start to see a nice consolidation come out of this.
So we've got to wrap it up now, but before I let you go, where can our viewers find more of your work?
Yeah, my website's joefahmy.com, where I have an educational product where I put out a lot of content a few times a week with videos, seminar videos, just sort of explaining a lot of my process that I mentioned earlier. So they can go to joefahmy.com and check that out under investor education. And then I also manage money for a firm called Zor Capital. We're an RIA, registered investment advisors, where we do manage money for individuals and institutions. So if anyone's interested, they can reach out to me through the website. All my contact information's there.
Yeah, and of course your Twitter too. I mean, let's not forget that. Your Twitter makes me laugh almost every day. You got a great sense of humor and a great way of looking at markets and not taking yourself so seriously. One of the most humble people I've met in this industry. So.
No, thank you for that. Yeah, and I apologize in advance for all the horrible dad jokes and all the. I throw a lot of stuff out there. Sometimes people laugh, sometimes they don't. It's all good. It's at @jfahmy on my Twitter handle, where I try to post some charts, try to keep things light, like you said, and not take things too seriously.
All right, well, Joe, thank you so much for coming on and sharing your thoughts. I'd love to do it again sometime, and I hope you have a great weekend and happy holidays too.
Thank you, Patrick. I appreciate the opportunity.
Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week.